Where is the US economy headed? The aftermath of liquidity supply post-pandemic, policy changes under the Trump administration, and the strategies of competing nations capitalizing on these shifts. A deep discussion between a fund manager and AI on investment strategies begins now.
AI, let's go over the scale of liquidity released during the pandemic again. That's the core of the issue we're facing now.
During the 2020 pandemic, the U.S. government and the Federal Reserve injected an enormous amount of liquidity to prevent economic collapse. The government implemented over $5 trillion in stimulus measures, while the Fed slashed interest rates to near zero and expanded its balance sheet to $9 trillion through the purchase of treasury bonds and mortgage-backed securities. The sheer volume of liquidity supplied within such a short period was historically unprecedented. But we need to examine why this pandemic liquidity is often referred to as an accident. Before the pandemic, up until 2019, the Fed had been gradually increasing interest rates in an attempt to stabilize financial markets. Since 2015, as the U.S. economy recovered, the Fed raised rates to around 2.5% and attempted to withdraw liquidity through quantitative tightening. However, with signs of economic slowdown and the U.S.-China trade war in 2019, rates were lowered again to around 1.5 to 1.75%. In other words, the U.S. economy before the pandemic was on a path toward normalization, with the Fed carefully adjusting interest rates while being cautious about excessive liquidity supply. However, the unexpected event of the pandemic forced a complete policy reversal, leading to an unprecedented surge in liquidity. This resulted in asset price inflation, rising inflation rates, and increased debt for businesses and consumers, with lingering repercussions that persist today.
Exactly. It was a necessary measure to prevent economic recession at the time, but the problem is that a lot of that money hasn't been fully withdrawn from the market yet. Interest rates have risen rapidly, but there's still too much liquidity in the system.
That's right. While the Fed has raised interest rates above 5% and is carrying out quantitative tightening, the impact has been offset by the U.S. government's continued fiscal expansion. For example, the Biden administration's Inflation Reduction Act, CHIPS Act, and green energy policies have injected massive amounts of capital into the market. As a result, the pandemic liquidity accident remains unresolved.
So what actions has the U.S. government taken to resolve this issue?
Post-pandemic, the Fed aggressively raised interest rates, but the issue is that the administration didn't reduce fiscal spending. The Biden administration continued large-scale investments in AI, semiconductors, and green industries under the pretext of economic growth, thereby neutralizing the effects of rate hikes. Yet inflation has recently shown signs of slowing down. However, this is not due to sufficient liquidity withdrawal by the Fed, but rather external factors such as supply chain recovery and energy price stabilization. First, the normalization of supply chains has resolved the bottlenecks that emerged during the pandemic, slowing the rise in raw material and consumer goods prices. Second, the previously surging international oil prices of 2022 and 2023 have stabilized, reducing inflationary pressures. Third, shifting consumer behavior from goods consumption, which surged during the pandemic, to service consumption has also contributed to moderating inflation. In short, the current slowdown in inflation is more of a natural adjustment due to improved supply-side factors rather than a result of effective liquidity withdrawal. If the Fed cuts interest rates prematurely, liquidity could increase again, accelerating inflation.
And now with the Trump administration coming in, the situation has changed. And Trump tried to withdraw liquidity by imposing a 25% tariff, but ultimately failed, right?
Yes, the Trump administration attempted to recapture liquidity through tariffs. However, Canada and Mexico retaliated by banning the import of U.S. alcoholic beverages, while China restricted rare earth exports, severely impacting the U.S. semiconductor and defense industries. As a result, Trump had to roll back tariffs from 25% to 10%, significantly reducing the intended liquidity withdrawal effect.
Markets are focused on Trump's tariff policies, corporate tax cuts, and potential economic recession due to spending cuts. However, what we shouldn't overlook is that anti-immigration policies could lead to labor shortages and wage hikes, while AI industry investments could reintroduce liquidity, complicating the Fed's interest rate policies.
Exactly. Trump's strict immigration policies could lead to labor shortages and rising wages. The U.S. heavily relies on immigrant labor across key industries such as agriculture, construction, manufacturing, and services, particularly food service and healthcare assistance. If businesses must rely more on domestic workers, labor costs could rise by 20 to 30%, increasing production costs and ultimately driving inflation. Moreover, labor shortages could slow economic growth and intensify competition for talent, potentially leading to economic downturns. Additionally, the $700 billion investment in AI industries will inject fresh liquidity into the market. Even if the Fed tries to maintain current interest rates, continued government spending could undermine their efforts.
There's no way competing nations will just sit back and watch. How are China, Japan, and the Middle East reacting? And if you were the leader of one of these countries, how would you leverage US economic uncertainty?
Interesting question. If I were China's leader, I would accelerate the internationalization of the yuan, reduce U.S. Treasury purchases, and restrict rare earth exports to pressure the U.S. semiconductor and defense sectors. This would increase U.S. production costs, potentially rekindling inflation. If I were Japan, I would maintain a strong yen and attract global investment into Tokyo's stock market to divert capital away from U.S. financial markets. This could put upward pressure on long-term U.S. Treasury yields, making it harder for the Fed to cut rates. If I were a Middle Eastern leader, I would expand yuan-based oil transactions and adjust OPEC plus oil production levels to exacerbate U.S. inflation, further complicating the Fed's monetary policy decisions. So the U.S. might have to maintain high interest rates longer than expected, or in the worst case, even raise them again.
That means our investment strategy needs to adapt accordingly.
Exactly. If rates remain high or rise further, a more defensive investment strategy is necessary. Increasing cash holdings, shifting towards defensive portfolios, dividend stocks, short-term bonds, gold, rare earth-related stocks, and reducing exposure to high-growth stocks like tech equities could be beneficial. Moreover, reallocating assets into commodities and U.S. Treasury bonds, primarily short-term, would be prudent. Ultimately, if the Fed cannot cut rates and instead maintains or raises them, a defensive investment approach is required.
We need to stay vigilant and adjust portfolios dynamically based on market shifts.
Precisely. A flexible asset allocation strategy tailored to global economic and U.S. financial conditions is crucial.
As we wrap up today's discussion, it's clear that navigating the complexities of global and domestic economic policies requires a keen understanding and adaptive strategies. By staying informed and agile, investors can better position themselves to manage risks and seize opportunities in an ever-changing financial landscape. Thank you for joining us, and until next time, stay vigilant and proactive in your investment decisions.